Hi, and welcome to this Think and Link series. I'm your host, Srinivasan. The month of May, that is this month, is an important and eventful month for two entities. First, the Reserve Bank of India, and secondly, the Ministry of Finance. You may be wondering why I'm saying so. The reason is it is in this month of May that RBI works out and transfers its dividend to the Central Exchequer, for which a lot of thought processes and number crunching is involved. For the Finance Ministry, which has already forecasted dividends inflow from the financial sector in its budget estimates, this is a nail biting waiting game. If the inflow is more than the targeted estimates, wow, that is good news. And if it isn't, then the budget numbers under this head and certain expenditure heads will have to be recalibrated. Now, having said that, the revenue side of the budget includes dividends to the government from the financial sector entities, and this includes RBI and public sector banks. But the bulk of the dividends flow from RBI. For example, in the month of May 2023, that is last year, RBI transferred an unexpectedly large dividend of about 87,416 crores. And now that we are in May, the expectations from the government could be that this year too, the dividends level could be more or less of the last year's level. So let's examine this hypothesis. First, let us take the budget for FY25 and what is the estimated receipts under the head of dividends to the government by the financial sector. And from there, we will build up the arguments. The budget estimates pegs the dividend transfer for FY25 at 1.02 lakh crore from the financial sector entities. Of course, this includes RBI as well as the public sector banks. Business economists expect that RBI will, in all probability, transfer around 75,000 to 80,000 crores, which is, of course, much lesser than the last year's figure. The likely lower quantum of transfer compared to the bumper payout of last year would be attributed to many reasons. And this is what we are going to see. Now, I think we all know that the dividend payout depends on the dividend distribution policy of a corporate or a corporation or a government undertaking. Dividends are paid are only after appropriating all the reserves and provisions are provided, and then whatever allocable surplus is there, the dividends are declared. So the same logic applies to the RBI dividend distribution policy. Now, in the case of RBI, the dividend distribution policy follows Dr. Bimal Jalan's committee report recommendations. I'm sure that every one of you all will know that Dr. Bimal Jalan is the former RBI governor. The committee, after the review of the existing practices governing central banks' reserves and transfers, it recommended what is called as a economic capital framework. So simply said, this ECF, that is the economic capital framework, is a methodology for determining the right level of risk provisions and profit distribution to be made under Section 47 of the RBI Act 1934. So that means this particular Section 47 guides the RBI as to the quantum and the distribution of dividend. So it is this framework which RBI adopts for dividend and profit distribution. As simple as that. Now, this report, that is the Bimal Jalan report, recommended the provisioning in form of contingent risk buffer. That is what is called as CRB. And it said that it has to be maintained within a range of 6.5% and 5.5% of the RBI's balance sheet. So 6.5% to 5.5% of the RBI's balance sheet. And this is nothing but it will comprise of 5.5 to 4.5% of monetary financial stability risk and 1% for credit and operational risk. So in short, what the report said that if you're going to have 6.5% as contingent buffer risk, 5.5 would be earmarked for monetary and financial stability risk and 1% for credit and operational risk. Now, just to give you an idea that the current balance sheet value of the Reserve Bank of India is around 70 lakh crores. So you can easily work out what is the kind or what is the quantum of the contingent risk buffer that would be required. Now, post this exercise only, the surplus income is transferred to the government as dividends. Now, the IDFC first, which actually ran through all these estimates, according to them, RBI's dividend is expected to be in the range of 75,000 crores to 85,000 crores this year. Now, that is because it depends firstly on the income and then, of course, on the provision. Now, when we talk about the income, let us see what is the income that RBI is expected to support. So, RBI's income, if you see that it is supported by first is the interest income on foreign securities and rupee securities, right? That is one of the biggest heads that RBI makes money on. And of course, it's earning on foreign exchange transaction. Now, when we talk about interest income on foreign securities and rupee securities, IDFC first estimates that the interest income from foreign securities is likely to rise with the expansion of holding of the foreign currency assets. So we are talking about the foreign exchange reserves that we have. And according to IDFC first, this is likely to rise because there is a likelihood of the expansion of the holdings of foreign currency assets. And secondly, IDFC first also says that income from LAF, that is the liquidity adjustment facility operations, are likely to be higher. Now, why is it so? This is because the system level liquidity deficit was higher on an overall basis during this year. So therefore, you can expect the income level to go up. And lastly, IDFC first says that loans to the commercial banks have been more than double the last year's level. And it is at 1.53 lakh crore. So that is on the interest side. Now, when we come to the foreign exchange transactions, earnings on foreign exchange transactions, which account for more than half of central bank's income, this is expected to be lower with a gross dollar sales of 151.4 billion between April and February 2023-24 compared to 2006.4 billion in the same period a year. So for one, the central bank has sold fewer dollars than the previous year, which therefore means that its income is going to come down because the commission income on forex sale will come down. Now, when we go to the other side, the provisioning side, as it is told you a rough estimate of where exactly the RBI's balance sheet value is. Now, IDFC first has said that its balance sheet has grown faster at 11.4% in FY24. That means in FY24, it is about 70.7 lakh crores as compared to 63.4 lakh crores in March 2020. Now, this raises the absolute level of the economic capital that the central bank needs to set aside, which in turn would definitely bring down the surplus. So, when we talk about the dividend payment, which is going to happen in mid May, of course, this is going to support the government surplus, and thereby it is going to support the government expenditure and liquidity. Now, having said that, what is going to be the outlook for FY25? That is this current financial that we are talking about. Now, this will all depend upon three important factors. First is foreign exchange flows. Now, we expect the foreign exchange flows to be slightly higher this time. Why? Because around 60% of the bond index inflows are expected to come in the second half. I mean, you all may be aware that Indian bonds have been included in both JP Morgan as well as Bloomberg indexes. So this will definitely support a lot of foreign portfolio inflows into debts. Secondly, there are also going to be other capital flows, which is expected to pick up in the second half when the US Fed starts easing the interest rates. That's one thing. The second important factor is the level of rupee versus the US dollar. That means I'm talking about the exchange rate. That will also substantially affect the income of the RBI. And thirdly, we are talking about the system level liquidity. Banking system liquidity is expected to improve in the second half of fiscal, supported by higher capital inflows. So if the liquidity increases, then there are very less chances for the RBI's income to spike. So to wrap up this episode, uh, we can conclude that the Reserve Bank of India's dividend transfer this year is likely to be lower. Outlook for FY25 seems optimistic, provided there are no further disruptions in the geopolitical front. So that's this. That's all in this episode. Bye bye. Ciao. And see you in the next episode. Thank you.